What's going on, everybody? Back with another video. Have you ever wondered why there is no fee trading in most of all these brokerages nowadays? You guys, right now, it might have something to do with these market makers and the transactions they have between them and the broker. Some of y'all might have been in the market for quite some time, but if you haven't heard of payment for order flow is the compensation a broker receives for routing trades for trade execution to a particular market maker. According to the SEC, payment for order flow is a method of transferring some of the trading profits from market making to the brokers routing the orders. So in short, just to make it clear, buy and sell orders for a particular stock goes to the broker. Then in turn, the broker sends those orders to a market maker whom executes the price on those orders. In between the buy and sell, and in between those buy and sells, that's where the market maker profits. A portion of the profit that market makers made will go back to the broker for routing those orders to the market maker in the first place. Let's talk about one of the most prominent market makers out there right now, Citadel Securities. They are a market maker and trading firm. As a market maker, it serves as a broker dealer that stands ready to buy and sell shares from investors looking to make a trade. Also, Citadel Securities executes trades from brokers like Charles Schwab, Fidelity, Robinhood, and TD Ameritrade. Citadel Securities is also mentioned on CNBC today, where it was discussed that retail investors may be making it extremely hard for market makers such as Citadel Securities to profit off of payment for order flow. Also, there's a finance professor by the name of Christopher Schwartz who will be talking about why there's a new study that shows no fee trading may be costing investors billions. Be sure to like, comment, subscribe on this video. Let me know what y'all think, and let's get right into it.
Right now, let's get more on the trading action of Bed Bath & Beyond. That meme stock has been extremely volatile just over the last couple of weeks. The company, in fact, is often the best or the worst performer in the S&P 500, depending on the day, maybe depending on the hour. Trading has been done by retail investors on platforms that often offer zero commission trading. However, there's a new study out that shows no fee trading isn't what it seems, and it may be costing investors billions of dollars a year. Joining us right now is one of the authors of that study, Christopher Schwartz. He is finance professor at University of California, Irvine. And Chris, let's talk about your study, because when I saw it, it really grabbed my attention. You went about doing this with some other professors. You put your own money at work executing trades, did them simultaneously across 5 different platforms, and found some very wide differences in terms of what you ended up getting for those charges. I guess it's proof that there is no free lunch.
Well, good morning, Becky. I apologize about my voice, but you're correct. What happened was we were doing another study and we opened a brokerage account and we decided to do one other brokerage account in parallel, so nothing related to this. And after the first day, the one brokerage account lost $150 and the other brokerage account actually made $12. And what we found was that it led us to this rabbit hole that you talked about, where we ended up placing 85,000 trades worth $17 million over 5.5 months at 6 different brokerage accounts. And basically, we found that the very best broker, you lost about 7 basis points on a round trip trade. So on a $1,000 trade, you lose about 70 cents. And on the very worst broker, you'd actually lose 46 basis points, or about $4.60. So the spread between the best and the worst broker was almost 6.5 times the cost.
Which is shocking. I mean, there had to be some reasons behind that. What did you find?
Well, so one of the SEC would probably tell you it's payment for order flow, but what we actually found was that there was no relation between the variation in payment for order flow and the variation or execution. So just to give you a concrete example, our number 1 broker has payment for order flow, but our number 3 and number 5 broker, in terms of best execution, in terms of price, actually don't have payment for order flow, so that didn't explain it. And ultimately what we found was essentially the market centers. So as you know, when you place a retail trade now, it doesn't go to the exchange, it goes to Citadel or Virtue or some other market center. Basically the market centers were giving systematically different prices to different brokers. So we'd have two trades go to the same market center at the same time, and they get radically different pricing on a consistent basis.
Chris, what did the brokerages say when you reached out to them, or Citadel and Virtu? What did they have to say about any of this?
So, basically all of them said that there's each broker has a different value for their order flow. So just to give you an idea, if I'm a brokerage and I have one person buy Apple and one person sell Apple, that's great for a market maker because they can just cross the two trades and then make profit. But if all of us are going out and buying BBBY at the same time, then obviously that's incredibly expensive order flow for the market centers. Like I'm guessing right now, Citadel and Virtu and others wish they didn't have to actually fill orders for BBBY. And so the explanation we got was basically the value or the profitability of order flow from different brokers is different.
When I read this study, when it first came out, I was kind of amazed because you think if you're getting free trading, it's free trading, but obviously there are costs behind the scenes. You used all these different brokerages, and I guess the brokerages were E-Trade, Fidelity, Interactive Brokers, Robinhood, TD Ameritrade. That's 5. I don't know who the 6th was. But in none of the reporting that I saw did it say who was the best and who was the worst. Why is that?
Actually, in the paper, we do name names.
Okay, tell us.
Of course, I figured you're going to ask, and we're academics, so we don't really like to trade and talk, Becky, but the number one broker was TD Ameritrade. They had the best execution.
That's amazing.
Go.